We're doing another budget with Velocity Banking, breaking down each credit card. We'll look at each one of their paychecks, what we're going to pay each of the credit cards with. We'll also look at doing Velocity Banking with their line of credit instead of their credit cards, and what to do about their annual bills, which total about $2,015. So you can account for these in your monthly budget as they come. So if one was $300 one month, you can put that in your monthly budget and account for it that way. The other way to do it would be to take the total and divide it by 12 months. And you need to set this amount aside for each of those bills every month. So there's really two different ways that can be done. Now let's look at doing Velocity Banking with a line of credit, which in this case might be easier because of how their bills fall. Let me explain. So she does have a couple bills here that can go on the credit cards, but there's a lot of miscellaneous and random spending over here. And with all of this stuff, we didn't have dates for it. So there's nowhere to put it on the calendar. If there were dates for all of these specific things, it might be a little bit easier to go in on the planner and figure out the Velocity budget that way. Let's see what it would look like to do it with the line of credit. Their line of credit has a balance of $14,735. The spending limit on that is $20,000. The payment on it was $415 per month. So if we're doing Velocity Banking with the line of credit only, we eliminate that minimum payment out of our budget by paying our income into the line of credit and then using the line of credit to pay all of the expenses. So the paycheck on the third is $3,285 that we pay into the line of credit. This brings the balance down to $11,450. Now remember, we've eliminated this payment here. Now we look at all of the other payments that we have to make during this paycheck. These expenses over here are this cash expense here. The food grocery store budget, I split that up bi-weekly. And then the miscellaneous and spending, I did the same thing here with the $388 every 2 weeks. So we would add up the total of all of these bills here. With the cash expenses here, most of those are probably actually being paid with cash. So you can take the cash out of the line of credit to pay those things. If this co-op comes directly out of the bank account, we could put $150 in our bank account to account for that. And the same thing with these other bills here. We could take cash to the grocery store. We could use cash for the miscellaneous and spending. And then these bills here, we could take the cash out of the line of credit, put it in the bank account so that those can come out of there. And again, we're going to go over how we can do this with the credit cards if we rather do it that way. Those bills total $2,384. So this is adding back to the balance. The balance would go back up to $13,834. And then we get the second paycheck, which is $3,035. So we pay that back into the line of credit. Then we use that line of credit to pay all of these expenses here. When we have loans like this, using a line of credit can be different than using Velocity Banking on our credit cards. We can pay loan payments directly out of the line of credit. It should have a routing number and an account number, just like a traditional bank account. And all of the other bills, same thing. You do have the routing number and the account number, so you should be able to put those on the line of credit as well. But if not, you can do what I said earlier, take the money out for these bills only and put that in your normal bank account. Then they can still come out of there. So after we paid $3,035 the second time, we go back in, we do the remaining spending. So after we've paid the second paycheck into the line of credit, the balance goes down to $10,799. Then we put all of that spending back on the line of credit, so $3,043. The balance would end at $13,842. So we paid almost $1,000 down on this line of credit. So this is one way to do it. Using a line of credit can be easier because you're paying everything into the line of credit and you're paying everything out of the line of credit. It's very important to make sure that these numbers here for these expenses are correct. If you're not sure exactly how much you're spending on all of these things, make sure that you track your spending for the last 2 to 3 months to figure out the actual numbers. Every method of debt payoff does work as long as you have your spending under control. The only reason I don't love using just a line of credit is the same thing can happen with a line of credit that can happen with credit cards. They can lower your limit on your line of credit. So let's say you paid in your first paycheck and the balance went down to $11,450, and they decide to lower your limit to $12,000. You're not going to have enough room for these bills here. This is the same reason I suggest using multiple credit cards as opposed to just using one. If they decide to take a look at your financial situation and see that you're a risk, they could lower the limit. Now let's look at the second option of using Velocity Banking with the credit cards. And you can actually do a combination of both. It does take a little bit more planning, but it can be done. You can use your line of credit, pay a large amount to your credit cards, and then use your credit cards to pay bills. But we're not going to go over that part today. So Velocity Banking with the credit cards, we're going to break down each paycheck. So the first paycheck, we get $3,285. We go through and we find the cash expenses. The cash expenses here are $604. That accounts for half of these expenses here. Remember, I did those bi-weekly. And then we have the electric bill that has to be paid directly out of the bank account. Apparently it can't be put on a credit card. So those two expenses total $908. We have $2,377 left to pay these two accounts here. So we have the SoFi credit card and that line of credit that we were talking about earlier. The balance on the SoFi credit card is only $156. So if we pay the $156, it is paid off completely. The minimum on the line of credit was $415, and this is without using the line of credit. Now we have to look at all the other bills that can be put on the credit card to figure out where those are going to go. So since the SoFi is paid off, I would just keep one bill on it to continue using it to make sure the account stays open. The bill that makes the most sense to go on the SoFi card, this statement will probably close somewhere around here. We could put this small internet bill on the SoFi card, or sometimes if you have maybe a Netflix subscription or something like that, that would be a good thing to go on a paid off card. The line of credit, in this case, I don't have us using it for anything, but you could use it to pay that loan that's due at the end of the month, right here on the 25th. If that's the case, they would pay this $1,100 to the line of credit, and then the line of credit would cover that loan payment. That loan payment is accounted for here, so if that were the case, we would have less cash expenses for the second paycheck. I hope that makes sense. The Visa I would use for all of the miscellaneous spending, which is $775, the app here, and the phone bill. So that's $855 going back on the Visa. And then the Apple Card, I would use it for all the food throughout the month, which is $1,850, the water bill, and the Apple One bill. So that's $2,013, and I'm going to explain why I have so much going back on that one card. Now, if we look at the second paycheck, we have $3,035. We look at the cash expenses. Remember, this is if we're paying the loan just directly out of the bank account, not using the line of credit. We have $1,731 left over. But we also had money left over from this check because we didn't use all of this money here. We had an additional $1,721 to use for these accounts. The balance on the Apple Card was at $2,249. So if we pay $2,249, we've satisfied the statement balance on the card and we will no longer be charged any interest. That's why I had so many expenses going back on that card. And then we pay the remaining to the Visa, which does cover these expenses that we had here. So we're basically using these two cards at the end of the month for the majority of the spending, which can seem a little bit weird, especially at first. But this card is already paid off. So using these other two cards for Velocity Banking to lower the balance will help save money and interest faster. This one should already have no interest as we're paying off the balance already. If you need help planning Velocity Banking and which cards you're going to use, you can get the Velocity Credit Card Cash Flow Planner. I'll link it below in the description. And then there's a more simplified version of that. I'll link that below as well. Now this here is the simple Velocity Credit Card Payment Planner. You type in your monthly income, you type in your cash expenses. That shows you how much you have available to pay to the credit cards after your cash expenses are paid. Then as you enter your plan payments over here, this number here will change. So let's say your monthly income is $10,000. Let's say your cash expenses are $5,000. Say credit card one, you plan to spend $500. Watch it update here, $500. So every time you type in a credit card payment, $1,000, it's going to update here the amount that you plan to pay with your cards. This amount here changes. So when this gets down to zero, you don't have any money left over to pay to the cards. And then you can plan each card. You can type in your bills and spending, your card limit, current balance, interest rate, the additional payment you want to make to have the balance go down, and it shows you how much you need to pay. Then you enter that number over here on the left side. This is the Velocity Banking Credit Card Cash Flow Planner. So you have a budget and you plan each one of your cards. So if we look at the budget, you can select from this list here how you're going to pay each of your bills. So maybe this is a light bill here, you type in the payment amount and then the card that you're going to use to pay that bill. Or if it's a cash expense, your cash, debit, ACH transfer, you can click that there. This breaks your budget down into 6 different categories, which is also very helpful. And again, you can do the same thing with all of those, select the card or a cash expense. Once you've filled out your budget here, then you go over to the cash flow planner. If we're looking at the cash flow planner, we have the limit, the current balance, the interest rate, and the current utilization. Since we filled in the budget setup here, the bills being paid with the card are going to auto-generate here. The interest amount will update automatically when you put in your current balance. You add your additional payment amount. Remember, that's the amount that you want the balance to actually go down on the card. It will calculate the total for all of these things here in your total amount to pay to the card. It will show your new utilization if you let the balance report at the lower amount after your payment. It'll show you what the balance will be back up to after your bills and spending, which is what is up here, go back on the card. Then it also shows you the dollar amount that the balance on the card will go down. The other fun thing about this is there is a paycheck planner. So if you type in your numbers here, you can also select which paycheck you'll use to pay each card. And then you can keep track of those numbers up here, how much you have remaining, how much is being paid to the cards. So both of these spreadsheets are really helpful if you're trying to do velocity banking. So again, I'll link both of these in the description. Let's look at the breakdown of each of these credit cards. So the SoFi card, we said we were paying $156 to it. That pays off the balance. The balance reports here at $0. There should be no interest on this card. Then we put the internet bill back on it. So the statement closes here. After the statement closes, we can put the internet bill back on the card. As long as we only use this card for the internet, all we have to pay is the $144 on the due date, and the balance will again report at $0. So that one's pretty easy. We're not paying interest on this card any longer. So we're just using it for the bill, paying the bill off. Now the Visa. Since both of these credit cards here don't close until the end of the month, there's two things you can do. You can either put the spending on the card before the statement closes, or you can pay these things here as a cash expense the first month until you get caught up enough to do velocity banking. So two different options. I'm going to go with the first option. So let's say we have to do $200 miscellaneous spending before the statement closes, which is not ideal, but sometimes when you're getting started, it has to be that way. So we spend $200 on it, then we pay the $1,203 that we planned. This is what the balance would report at. So it went from $4,594 down to reporting at $3,698. This is what helps our credit score. Then after that statement closes here, we could put the remaining $665, miscellaneous spending, the remaining amount, back onto the card. Then the balance would go up to $4,363. And then in November, we would pay the $1,203 again. They're going to add a little bit for interest, and the balance should report somewhere around $3,200. So this balance started here. The first month it reports here. The second month it reports here. Now the Apple Card, remember I said if we pay the full balance of $2,249, we should be charged no interest. And you actually only have to pay the statement balance, not the full balance. But I'm assuming that was probably the statement balance or close to that last month. Again, this is one of those cards that we'll probably have to use it first, which does seem really weird. If you don't want to do that, you can consider these cash expenses and just pay them out of your bank account and then start using velocity banking with this card the following month. But if we're doing it like this, we would put the $1,850 for food on the card, we would pay the water bill, and we would pay the Apple One bill. Balance will go up to $4,262, but we're going to pay the card before it reports. So October 31st, we would pay the $2,249. Remember, that was the starting balance. I'm assuming that this was also the statement balance. So since we pay the statement balance off here, the following month we will have no interest. The first month we will, because our statement balance from the previous month was not at $0. So they'll add a little bit for interest. The balance will be around $2,302 when it reports. So this month, even though we paid $2,249, that balance is going to go up slightly, but we front loaded all of these bills here. So the balance reports at $2,302. We put all of this spending back on the card here. The balance goes up to $4,315. Now on the 31st of November, before the statement closes again, we pay that same $2,249. Actually, you need to pay a little bit more. You need to pay $2,302. So these numbers are going to be about $50 off. So we pay off the statement balance here again, maybe pay a little bit less to this card to make up for that $60. So minus 60 here. So the balance would have went from reporting at $2,300 to $2,100-ish. Then same thing, we go back in, we put the bills back on the card, the balance goes back up, but we're paying it again before that statement closes on December 31st. I'm sorry, this would be the 30th. I'm just making all kinds of mistakes today. So December 31st, now we can pay the same amount that we planned to pay to the card, $2,249. So that's going to be slightly over what the statement balance was. So we're still good on paying no interest. As long as we pay off the statement balance, we won't be charged any interest. So this will save some money in interest that can be used to pay off other debts. So December 31st, we paid the $22.49. The balance reports now at $1,830. So you can see the balance went up slightly the first month just because we paid all those bills with the card. But the months after that, the balance reported lower here and the balance reported lower here. This works as long as you stick to the numbers that we've accounted for in this budget. And again, if it feels really weird and you don't want your balance to go up at all, in case you feel like you might not be doing this right, you can consider these cash expenses for the first month, and then you have to figure out how you can get to the point where you can start putting all these bills on the card. But this here is the reason that I said it might be easier in this case to use the line of credit. You can also use a card for some and the line of credit for everything else. You just have to plan what you're going to put on each card. So if they wanted to, they could use the line of credit for the majority of the bills, but then they could use the Apple Card here, maybe for just these bills and a little bit of miscellaneous spending. So we would account for all those, make sure that we pay enough to the Apple Card on the 31st of the month to cover all of these plus interest. In that case, we would still be charged interest on this card because the statement balance won't be paid off. So there are many different ways to do this. This budget was a little bit more difficult just because of all the extra spending going on here that we didn't have dates for. If these do have dates, we can go in and play with it on the planner. But it's also difficult because we only have one card maybe closing around the 7th. These other two probably don't close until the end of the month. So they can do this with the credit cards. It's just a little bit different than how we normally do it because of how things line up. Or they can use the line of credit, but do be careful just using one account. If you want to start slow with the line of credit, you can pay everything as you normally do. Try putting that one loan on the line first. Make sure you're good with that and the balance is going down, everything's being paid properly. Then you can slowly add more things in as you go. And you can do the same thing with the credit cards. You can just start with a couple bills first. Pay everything how you normally do. Pick a couple bills that you're going to put on each card and start there. Always remember, the most important thing about velocity banking or any method of debt payoff is that you're sticking to the numbers that you have planned in your budget. If you're not sticking to your numbers, especially these things over here on the side, these are where things get out of control. And if you're not, you need to go in and track your spending for the last 2 to 3 months, print off every credit card statement, every bank statement, go through everything, put it in a category, and see how much you've actually spent. Your debt should always be getting lower every month, not going up. If your debt is not getting lower, you more than likely have a spending problem somewhere that you need to address. But anyway, we played with the numbers a little bit here. We have 2 different options, the line of credit or the credit cards, or possibly using both. So that will be up to her to decide. And she's also going to have those spreadsheets that can help her plan these things too, so that may be helpful. But anyway, if you have any questions about velocity banking, credit cards, credit scores, paying off debt, or anything else, feel free to let me know.